When you partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron.
Hello and welcome to Moving Iron Podcast. I've got Rich Posson from Critical Point Podcast back on here to talk about what's going on. Rich, how you doing this morning?
Very well, thank you.
Are you a deep fried turkey guy, or are you a oven basted turkey guy?
I'm more
for Thanksgiving?
oven basted.
Yeah, me too. I like the oven basted stuff. It's more. It seems like it's a lot more tender and a lot more moist. That's what I dig about it. Big plans for Thanksgiving coming up. You got anything going on?
Not huge, just small family gathering. And
Yeah, I've got going back to Wichita, so we get back there for 4 days. So we have to go to I don't know how many. My wife keeps track of how many places we have to go to, and it's quite an extensive list. So I kind of hang out and wait to see what happens after that. But Thanksgiving is one of my favorite holidays because there's no pressure. You just eat too much and watch football, and I don't know how much better of a day you could have. You know what I mean?
Yep.
It's heaven. All right. Well, Rich, you do a podcast called Critical Point Podcast, and talk a little bit about your podcast, where they can find it, and what they can get when they get on there.
Okay, so the podcast provides daily, weekly, and monthly type updates via audio and video. I don't have a newsletter. Did it with that many years ago, and people just found the videos very useful because they could actually see all these model signals and the opinions and see how well they're working, whether they want to do something on the next signal, that kind of thing. So I do put out signals in the stock market and corn, wheat, and soybeans. The rest of the markets I look at, and the economy, it's really more analysis and general idea. It's not like a hard, concrete signal. And so I look at business patterns and cycles of the economy and stock market and the grains. But I also include crude oil, Bitcoin, the dollar index, and then interest rates and bonds. And lately I've been doing some bond trading myself here, making a long-term move actually, and I haven't done that in a few years. So they get a wide variety, but the primary focus really is stock market, economy, and those three grain markets. And they can find me at criticalpointpod.com. That's a website that explains myself, and there's a blog there and a few other things, but there's a page that will take you over to the host who takes care of the podcast. And you can actually go directly to that if you were to have a problem in my site. And that direct address is criticalpoint.podbean.com. And bean is like soybean. And if they go there, they'll just see simply a list of audios and videos that's available. And there are links to sign up and get on board with the subscription service. And it is worth giving it a try because, yes, I will fill you in on what's going on. Like I quite often do very well at saying, well, the stock market's going to be up today, down tomorrow. That's short term, and it can be quite accurate. But I'm really focused on the larger trends during a month, during a year, and for a year for the stock market and all the other markets. And then I expanded into what are we doing for the decade in terms of the economy and stock market. And that's worked very well. And believe it or not, I actually have a major long-term signal when I sell the stock market once a decade and buy it once a decade. And it's related to the economy when it turns down for a recession. And then when the recession's over, we rebuild our economy. We seem to always be able to print the money no matter how much we print it. and we rebuild the economy, it works again. And some examples of that was in 2008, 9, it was 2009, March 2009, I called a bottom in the stock market. And that was the bottom month, but I forget how close I was to the day. And I said, be bullish to 2018, 2021. And expect another recession. And we got it. It was a weird one. It's called a COVID-19 recession. And so highly unusual, but It actually worked. We got the recession and actually sold out within hours at the top in February, although I had taken a couple stabs at it previously. And then March 2020, I turned long-term bullish 2 days after the bottom. And I cannot guarantee I'll be that close ever again, but it worked. And I still own investments from 2020 that are up like 100% or something like that. And I don't intend to sell them to near the end of the decade for that type of signal. So the bottom line is I offer things for very short-term traders, more like intermediate, long-term to even very long-term. And when we get into that long-term, it actually helps business people who may not be interested in where the stock market's going, but they just want a handle on markets versus the economy and where's business going. So I've done this for decades now. The podcast I started probably 5-7 years ago, and it's worked well for me. And we'll just continue to keep knocking out this analysis and see what people can use it for.
Right on.
So,
A lot of good stuff there. I mean, it's amazing what you've got on that site. So check that out. All right, so let's talk a little bit about the Fed, what's happening there right now. The Fed came out earlier this month and said, hey, you know what, we're not going to raise rates like we said we were. We're going to hold off for just a minute and see what happens. You still have the December meeting to come through that can we can still come in and raise rates if we talk, if we want to, those kind of things. Never gave any indicator that they were going to do lower rates or anything. They really didn't say anything other than we're not raising rates this time. And man, did the market react to that. It's a complete reversal, almost 180-degree reversal of what we saw leading up to that meeting.
I know it's absolutely amazing. And really the stock market has stretched a rubber band going into the end of October. My model was saying, this is getting insane. It's irrational. Something has to give. And I finally decided, I think they're going to try to be negative right up close to the Federal Reserve. And then they'll buy like the 2 days before. Well, that's how it worked out. They started buying Monday, Tuesday. And then Wednesday, the Fed come in and that thing just exploded. And it just kept going well into the next week. And then we got the CPI inflation report and it went higher still. And this morning, it's trying to pound out a new high since that bottom in October. It's working higher and the model is saying, well, it should. And I am positive the market into December. So what really occurred? Well, again, I think you had some huge players that were just far too bearish. And in late October, they got it low enough to scare the small investor, what we call the retail investor, who finally gave in and sold. And I think they used that as a signal saying, now we got this market beaten up. Those people are going to be wrong. And they started to backpedal a little just in case the Fed Reserve. But the strange thing is when the Fed Reserve come out, like you said, they really didn't give us anything to be bullish, but it's like the market couldn't help itself. It just said as long as it wasn't negative, as long as the Fed didn't say we are raising rates, let's just go. And they just stampeded over one another. And there's even a billionaire who supposedly had a nominal bet of 1.6 billion to the downside. He made a fortune in 2008, 2009. But he's out from what I understand and basically got burned on that position. So just an abrupt change here. And I think the retail investor is behind getting back in. I think there's plenty of money on the sidelines to come back in. I do think the professionals, they got some bought, and they're not as far behind as, say, the average investor out there. They're kind of ahead of this thing. Now the dilemma comes that it rallied so fast. How do you put more money in? Or if you didn't get back in, where do you get back in? And that's where I'm hopeful the model will help us on a short-term basis of picking off some of these moves. Because as you're aware of, for a year now or more, I've been saying we want to be bullish for 2024. And in October of last year, I said it's time to be bullish for 2023 and 2024. And that has worked. But I must say, even I was taken back by late October, just how negative they were. And it just didn't add up, make sense. And I think the market has spoken here saying, yep, that was an oops trade. They made a mistake being that negative here. And now It's just amazing how many people were saying, even watching CNBC, Bloomberg Television, is just saying, boy, some of these people were blood-curdling negative and bearish, and now they're just outrageously bullish, just overnight. And so people might be getting a little carried away. We'll have some setbacks. There's always going to be some trickling news on the negative side. But overall, I'm feeling pretty optimistic. I wouldn't be surprised stock market's up 15, 19% for the S&P 500 next year. And if that's not a good enough for people, then there are products out there that can make it better for them, that they can handle more risk. And then, of course, stock pickers will do their best to try to find the stocks that will outperform that index and that kind of performance. But yeah, I think, it's almost like a sigh of relief that people really are convinced we've beaten in the inflation game and the Federal Reserve is going to go away. So let's discuss the future, where the Fed's going. Again, they didn't tell us they would not raise, but dropping the inflation, let's see, we had 2 months of 3.7% CPI, and then for October, it dropped to 3.2, which was kind of my gut feeling, but I couldn't quite prove it, didn't dare forecast. I just said, I'll take whatever they give me. And so I was pleased with it, and I think the market was very pleased, but really, when you look internal, like on the core inflation, that only slipped like from 4.1 to 4 or something like that. Not necessarily an aggressive change. So again, even the CPI inflation didn't really give us as bullish news as the market seemed to dial in. So I think inflation will be a slow struggle, frankly, going lower. But I will say, increasingly, there's some big Wall Street firms coming out saying inflation might actually take a nosedive. CEO of Walmart said they think we better start talking deflation. And when you have inflation, obviously prices are moving higher. And then when you have disinflation, prices are still moving higher, but the inflation rate is coming down, meaning prices are moving higher at a slower pace. Then when you go in deflation, it means prices are actually dropping. And if you look at the history of this country, the CPI has basically always gone up. So prices basically always go up. But when you look on a short-term basis, yes, we have moments of sudden drops. Most of the severe drops, though, relate to recessions. And we normally only get what I call a primary cyclical recession. We get that about once a decade, normally at the beginning of the decade. Sometimes it's towards the end of the prior decade. And so we're not due for that. So to me, I don't think we're going to have aggressive deflation, but a lot of people don't understand that. As soon as they hear the word deflation, they get concerned. Maybe this is one of those things that's too good to be true. That, yeah, we like the lower prices, but then we get scared. Is it going to spill over in recession? Well, so far, I would say these big Wall Street firms talking that word deflation are also saying, but it won't spill over in recession. We'll get a soft landing. So this is another reason why they bought stocks aggressively, is they're thinking this could be a sweet spot when inflation comes down now faster than what we were thinking, but we don't go into recession. We're just getting back to a normal economy. It's going to be a good thing. And these companies will make money and the stocks will be worth more. Another fascinating, remember the transitory battle over that war or a battle over that word? And pretty soon nobody dared to even mention it. Mm-hmm. And Lawrence Summers, who was on the Federal Reserve, I believe, and then I think he was a Treasury Secretary, but I forget which president. He was one of those who was just pounding all year long. The Federal Reserve better not let up. Get those rates right up there, 6.5%. Just keep pounding it. And he's done an abrupt turn as well. He's saying, gosh, maybe this inflation was transitory after all. So I think what's going to happen now is the people missed out on this run up, or they didn't get enough bought, kind of missed out. I think they're going to dial in that things are going to be okay for the next year. And I think that's going to keep us from large drops in the stock market along the way, unless we get some news of something blowing up in the world. That can change it. But my guess is it would only be temporary, though. I really think we are set for GDP, and I've said this, that this should last for the rest of this decade of like 2.5%, 4.5%. Inflation can go 1 to 4.5 as well. So we may see a rebound inflation later this decade before the recession. But from now into 2025, I've said the rates or inflation ought to come down, and therefore I think interest rates should come down. And that's looking, I haven't been the only one saying, there's been quite a few betting on that. Even the Fed Reserve, some of their dot maps kind of pointed towards lower inflation, lower interest rates going into 25. But it looks like things have changed well enough that we need to have some faith in that. Take a chance on it. And I think that what's the stock market's telling us, just take a chance that, hey, this inflation stuff's over and done. It may not actually go away, but we don't have to worry about it. And frankly, if I was running the Fed, I wouldn't think of raising interest rates unless the inflation goes back to 5.5. I'd give it some wiggle room now. And so I think this is going to work. We're going to just keep working this inflation lower, and the economy is going to continue to grow. The consumer was red hot in August. I think it was August, purchased huge amounts, really backed off in September, which makes sense because they bought too much basically. But there's now people doing studies of what's going on in shopping malls. And one of them said they hadn't visited a shopping mall in a year. And when they went there, the parking lot, they had to go to the overflow parking lot. It was jammed.
Yeah.
And, so we have a chance maybe of Christmas doing quite well for sales and Thanksgiving doing quite well. But we'll see, and I'm optimistic we're going to see a Santa Claus rally in the stock market. And I think this is going to spill over into next year. Just realize there's going to be setbacks along the way.
Sure.
But I think this negative news, when you're in a solid bull market, you get news that in the past might have made the market go down several months. So it worries people. And then in hindsight, during that growth phase in bull market, you find that same news knocked the market down a couple of days. It could be that different. Okay. And so that's what I'm watchful for, of don't overreact to some of this bearish news. I mean, protect yourself if you need, if you think you need to, but just be careful, because that's what stung some of these major bears. Like I say, there's multimillionaires and billionaires that they just took a bath on this run up because they were so incredibly bearish. And some of them, I think, some of them may return and sell at times, but I think most of them are saying at times they'll be short-term sellers, but they're now going to be long-term buyers. Right. I think that's where the big boys are going with this.
Yeah.
So, what else can I tell you on the CPI inflation? Again, I think it'll go down. Well, obviously this should play a role in interest rates. So I believe the Fed does lower rates, and man, it's all over the map. Some people are saying as soon as January, February.
That was my next question for you. Is keep tossing around this March time frame to lower interest rates. So
now there's even more of them on March and a few in January, February. I think they get a little carried away there. I think I'll stick with May, June, July. I think that's what I said last month. Yeah. I think I'll stick with that, but I can see it coming sooner. It just depends how fast that inflation drops. And will the Fed be concerned of, okay, maybe we ought to put the brakes on it now. We put the brakes on rising inflation. Now let's put the brakes and not drop it too fast. But I don't know. I got a gut feeling they're going to hold out till late spring, summer, and then they'll drop them. Now, there are some people saying it won't be till late 24. Other people saying, no, it'll start a lot sooner, but they might come down slowly. They might skip a few meetings and not do anything. But those same people are saying you might see interest rates really come down sharply in late 24 to 25. Well, that's interesting, because I have a story of, yes, I'm bullish 24 and optimistic, but in 25, I am going to look for a hiccup. And I'll see if I can back out, take some profits, and get right back in. But I don't doubt we'll see a little something going on there. Well, that may be because we're going to see a little hiccup in the economy, but maybe the Fed says, let's make sure it doesn't turn into something more serious than a hiccup. And that's where they could be more aggressive, lowering the rates. And in my opinion, that'll just create the next boom in 26, 27. So even if we get some issues in 25, I just want to point out to people, I am bullish for this decade. I'm very convinced this will work. And I've been at this with this model since 2000s, but in 90s and 80s, I was also working something like this model. It was kind of discovery phase. And so real time from 80s, 90s, 2000s to now, but I'm a believer in back testing, proving what you think. And I've done that going all the way back and well into the early 1800s for the history of this country, for the economy, and even for some stock indexes actually go that far back. So I know how it's worked and not worked, and I'm feeling pretty comfortable right today. I almost have a sigh of relief, because really late October was starting to bother me. I was thinking, why are they that bearish? How can their analysis be off? Well, it was. Okay. And I think instead of them trying to return to that, again, I think some of the big boys and girls are going to be optimistic now. And I think that supports the market, going to support the economy. I think I'm probably being a little too brave here, but I think even some of this political news stuff where we're kind of poor thinkers and we get too excited, too much drama, I think that's going to ease back a little bit next year. I don't know how much, though, because, granted, Russia, Ukraine may continue on through next year. Now we have Israel that may continue on through next year. But I am encouraged. Billionaire Ray Dalio, who was forecasting a war, he was forecasting a financial crisis, he backed off and said he's kind of pleased of what China and U.S. have been discussing here in this latest meeting. He doesn't think you'll see a war, near term, like the next couple of years or something. I think he's still concerned farther out long term that something might go wrong and we're kind of in a Cold War. And I think these people are really looking for some kind of blowout if they're going to be right. I don't think they're going to be right to the year 2030 when I get my sell signal. I'm that confident of it. And so that's why I want to be cautious of following some of these bearish people in the next few years, because it might hold you back from maximizing your gains, your profits, and doing business and enjoying life a little bit before the storm finally hits. And again, they can be right. I just feel like they're off a few years, and things can get better first. And then we'll discuss that at the end of the decade when I get that sell signal, just how severe is it going to be. So,
All right, let's talk a little bit about GDP. You've talked about growth and a little bit here already this morning when we've been talking. All the indicators come out showing that there is growth in the economy right now, where we did see some decline, probably early 23, late 22, but again, that was coming out of the COVID recession. So we talked about that a little bit. But as you look right now, moving forward to GDP, what are your thoughts there?
I think we're going to see 3.5 to 4.5 next year, and maybe even early next, the following year, and then probably a little dip in that GDP in 25, but nothing drastic. But yeah, I think we've already seen I follow the Georgia Atlanta Fed, and they have a thing called GDP 10 Now, and you can even get an app on your phone, and they update you a few times in a week with, I don't know, maybe 6, 7 indicators are following. And the problem is their GDP, they can get too excited about it. For the third quarter, they were as high as 5.5% GDP. But you know what? It actually finished at 4 point something. So they weren't that far off, actually, compared to their prior history. But I think a lot of people misunderstood that, and that's why they got worried the Fed was going to raise their rates. That was for the third quarter annualized. During the fourth quarter, we normally back off on GDP. It's just how we do business. The better time of our economy apparently is in the summer. And it backed off this time for the fourth quarter, and this is only the first reading, so we don't know for sure where we're at, but they backed it off into the 2% area. And I think that's about right. I think for the end of the year, we'll be in that upper 2%, lower 3% is what I'm thinking. But what I'm saying is next year, I think we can have add a half to even a full percentage point for that annualized GDP. And I think that's pretty good. I'm not so sure we need a very good GDP for the stock market to be very good, frankly. But I think for most business people and the security of their jobs, they'd probably like the better the GDP, the more comfortable they may feel, Right. Yeah. And so, yeah, I think we'll be in that 3% area anyways next year for GDP.
Right on. Okay. All right. You've hit on the stock market already. We won't belabor that any longer, but stock market seems to be moving in a good direction. It seems like it's on a fragile footing. I mean, I think if the Fed came out in December and said, hey, we're going to raise rates at a quarter point, you'd see a pretty big crash in the marketplace, I think. So you take a look at what's going on there, and then you throw in commodities in that mix, and we're seeing some inflationary moves in commodities for sure right now, more than we've probably seen over the last. We're starting to kind of build into that, I think, a little bit into that inflationary commodity marketplace a little bit. And with what's happening in Brazil as far as the weather patterns we see down there right now, looking at those two things, Rich, what's your 50,000 foot view on the stock market and the commodity market right now?
Yeah, well, I'm bullish in the stock market and I've done well with it for 40 years, so I'm pretty confident in it. Commodities don't follow the same type of decade pattern. It's there, but it's got a different characteristic, and that's basically because we really, as consumers, can't handle commodities moving up every single year for 10 years. Whereas investors, we very much like the stock market going up every year
Right.
for 10, and the stock market shows it can do it. Okay.
Right.
10 years nonstop, even. We found periods of history like that. But commodities generally is broken up more, and it has to do with supply issues and demand issues, and you're getting more into the microeconomics. But there is a definite macroeconomic force in there. And basically, for commodities, I think we've seen the decade best bull market from 2020 into 21, 22, even 23 for some commodities, depending on which commodity you look at. And I do think commodities back off into 2025, maybe only to late 24, just depends what's going on. But I will point out, at least for the grains inside of the commodity group, you can get a weather issue, you can get a supply issue. So we could even see an explosive move in 24 off weather, perhaps. I don't really have enough data now for that, but I know my C model, which is based on patterns of yield from year to year and production, and I do it in temperature, production, or precipitation. And what I was saying, and I told people this many years ago, I think about 2016 was the first I started talking about, especially to some commercial global companies, expect a bull market in grains in 2021 to 2024. And I said it can start sooner than that. It could work its way up into that. And then I said, also expect a rise in inflation because super cycles should be turning up then. And I said, expect a rise in interest rates, whereas the super cycles actually bottomed for the economy and stock market back in 2009. So they split apart. And in August 2020, I did say to people, hey, we got a super cycle bottom in interest rates finally. And I said, if inflation didn't bottom back in 2008, 2009, it's going to bottom with this interest rates. Well, the COVID made the inflation move over to combine with the interest rates. So I've been right that this came to fruition that helped push these commodity prices higher. But it's really the best move per decade. So I'm a little reluctant to say commodities will be much higher later in a decade. If we had a 1970s inflation scenario, and I do not believe we do, but I know there are some similar characteristics, then we could see firmer commodity prices later this decade. But I think if there's going to be big up moves later this decade, probably another weather or crop problem, and even more so if we don't get it in 2024. And let's just talk a moment on that crop problem before I switch back with these commodities inflation. I will say that I have that C model, and it's saying the best decade type up move should be over by 24 if we haven't already seen it. And we haven't really seen the crop problem to drive it. So I think it's out there. It can happen next year. But I have an R model. And the R model is a little bit different. It uses some other things like even cosmic rays and sunspots. It has various inputs of what can impact climate. And that model was active, or what I call active, from 2015 to 2019 when it was warning we can have one or more crop problems. And in 2017, we got a problem in soybeans and wheat in the U.S. Yep. We didn't get the problem in corn, which was a bit baffling to me at that time. And I remember working with some big commercials, global commercials, and I used that model to help with forecasting of issues in 2016, 2017 down in South America. They had La Nina. Argentina took a big hit. Brazil got clipped some. And then even Russia, I believe, was in that time frame of a problem, so it helped there. But the corn waited to the last year, 2019. I thought, where is this problem? What's going on here? And it was a weird problem. It wasn't hot and dry. It was wet and cool. And yet we knocked the yields down, okay, and we altered production. And it did create a bounce for the summer, and then it was all over. But the point is it did meet the definition for a crop problem. So it worked. But the model then deactivated, meaning you don't use it. But we have, in recent weeks, I told subscribers, I'm reactivating the model. We have the ingredients, the input. Now, I'm also warning them, and therefore I'll warn everybody listening to this, I'm being more aggressive. I'm being more of a timer, whereas that R model, normally I'd wait for a lot of evidence, and sometimes all the way till March, April, just before we start the planting season. And I could be making a mistake of being too early on it. It might backpedal, even if it for some reason didn't work. That could reactivate over the next 2 years even and make even a more serious problem late this decade. But today, I'm very intrigued with that model. It's got the inputs there when I'm saying we now need to watch for crop problems 2024 to 2028. Inside of that, if I use the C model, it's pointing to the most important problem ought to be in 24, if it will work, and nothing's guaranteed. And then there should be a second most important, a little less of a problem, around 26, 27, interesting enough. Now, that can move around over time, but at least this gives us a guide to watch for signs of when things might change that supply story and make it more bullish, And there are people watching the Gleisberg cycle, such as Sean Hackett works with that. Yep. From what I understand, that runs a range of 2023 to 2027. Now, that's based more on tree rings. If you use the sunspots where it was discovered, it's a wide range. I wouldn't be surprised it already occurred and isn't going to work the way they're predicting. But I don't want to be against them either because it may still work. But what I'm fascinated is if I take that Gleisberg and use that R model and the C model, then maybe it's 2024 or it's 2026, 2027. Okay. So we'll see what we get. Obviously, you can do all the work you want, but until you see the crop grow, you really don't know. There's
That's
just
right.
no way of knowing for sure.
And, that is for sure.
And so, but I am intrigued by it that we could get that kind of a bull run. And then what I think happens in 2025, we see a really good crop. We see lower prices, and that'll coincide with my lower inflation into 25. And I have commodity indexes where the model is bearish into 25. So I think grains can be the rebel, the renegade, and go the opposite direction maybe next year. Then they're just going to snap right back to being in line with the commodities. And I'd also warn that when I look at precipitation, we've actually declined in the Corn Belt for a few years now in precipitation. It's a little unusual to last that long. So if you want this crop problem, you better pray you get it in 24 because somewheres during this decade, we're going to snap back to very good precipitation and very good crops. So we could see things turn on a real dime where it makes a very bullish scenario for 1 year, and the next thing you know, it's quite bearish for a year or two. Okay. And it's been a while since we've pounded out a new record high in corn yield, and even soybeans are kind of stalled. So yeah, I think we'll see some good crops, later this decade, but there's still that chance for a crop problem sometime. And for the moment, I have to give it a chance here next year, and we'll see what we get and then reevaluate it. But how this relates to all the other commodities, I think what you're looking at is the world and the U.S. is getting back to a better balance of supply and demand. We're increasing production actually. And I think that just calms down these markets. I think you've seen the big bull run here in just the recent years here in general. But grains can could perhaps relive a glorious run up here in next year and be a little bit different than the other commodities.
Yep.
And that'll be interesting to see. Some might say, well, we don't want to see the grains up because then inflation's going up. Well, really, in my commodity index work, I'm not so sure it'll make that big of an impact. What you have to watch out for is will all the commercials and all the other commodities jump on board of that and try to fight for a higher price because grains are higher? And will the then end users panic and try to hoard commodities, buy ahead? And will then that make it worse and spread it throughout commodities when those other commodities really shouldn't go up? If the Fed Reserve sees the majority of the list of maybe 30 commodities going up, they're going to worry that something's still amiss here of too much money running around out there. And then they will be worried that they're going to have to start fighting inflation again. But for the moment, I think this grain thing is just for the grains. And I think the overall commodities won't give us all that big of a problem here in the next couple of years on inflation. Same for crude oil. I realize OPEC can be powerful, and they're already trying to maybe work it a little harder here for some cuts here. But we've got record production in oil. And even though the Fed or even though the government needs to buy oil for its strategic reserve, our production is so high, and with our exports, to me, the exports can almost be another reserve. That if we're in trouble, we can say, sorry, we're not going to deliver you that oil. We want it for ourselves. So that creates a cushion here. So I'm not too worried how quickly they can rebuild that strategic reserve at these prices. I think they better be working at it to be safe. Don't blow it after such a actually pretty good move. And by the way, unfortunately, the government blew it on the interest rates, so we should have been locking in longer term rates, But for the moment, I think we're on track to lower this inflation, but keep in mind the grains could do their own thing here, right, and give us a nice bounce next year. I didn't fully talk about on interest rates. I do think they're going to back off into 2025. And I think I just detected what I call a minor long-term bottom. It's kind of a 3 to 4 year pattern. Think of how a decade works and you divide it into quarters and stuff like that. So I actually bought bonds for the first time in years, even though I give many buy signals during that time. I just don't personally have an interest in trading bonds, but I help my subscribers saying, if you want to buy bonds, here's a signal. I like the stock market. I think there's more money to be made in that. But this one intrigued me this time around. And I thought, what if these people that think interest rates really could drop hard and fast would make a nice little investment? So I don't have a big position on it, but I own bonds. I'm profitable this morning, even though I got in a little later than I wanted off of that bottom. And so I think we got a chance to ease these interest rates back into 2025. And then you might want to think about that they're going to rebound a little later in the decade, because normally interest rates will be moving up when you go into that peak for the economy per decade and that once a decade sell signal. So we'll want to keep that in mind eventually. But for the moment, I think we could be hitting close to a little sweet spot here and get the stock market up there and ease the interest rates back.
Yep. All right. So I called you about something on this interest rate thing. I called you about something that was kicking around in my head and kind of wanted your opinion on it. And in the reverse of what you were talking about. So I called you about, hey, some short-term lending that may be coming up right now. You're looking at 7.5%, 8% on equipment trends right now, equipment lending right now. But if the Federal Reserve decides to come in and start lowering rates and those kind of things, you could see something over the next 3 to 4 to 5 years where if you lock in something right now, you could be 2 or 3% under that by the end of time. By the time that your note comes, when you've paid off your note. What's your thoughts on variable rate financing right now with some of these signals that you're getting from the Fed that there may be, even if things just stay the same, I mean, it'd be one thing, but I guess as you're looking at variable rates, I mean, what's your thoughts on that? And do you feel like that's a strategy that you should take a look at?
As anybody who's actually done things with variable rates over the years, I think they could be more confident in an idea of, let's hold out and see if we can get that rate down and then maybe lock it in a little later.
And I'm talking short term here. I'm talking 3 to 5 years, right?
Yeah. So I think there's a good opportunity for that. I mean, that's why I bought bonds. I'm feeling pretty confident they're probably going to lower rates next year, and that could spill over into 2025. It may even spill over in 26. I think you should get out 27, 28, 29, but I start thinking of a little rebound in rates, and I don't know if it'll be little or large. But I think there's an opportunity for that. And I can see people who have done it in the past might feel more comfortable with. People have always locked in rates. To me, rates rally too fast, okay, relative to the economy. It was not necessary to do that for the economy. It was necessary to try to change the attitude of people and businesses to fight inflation, okay? Well, now we're winning that battle on inflation, so we don't need to do that. So we really don't need these rates staying this high.
Right.
So I think Wall Street's got it right. I think the banking community's got it right. And I realize there's some that they're on the opposite side of this. They think they're going higher anyways. But again, something abruptly changed here in the last 2 weeks where you have more than I've seen in a year now of people and businesses saying it's time to actually drop the rates. And I think it could work. And so somebody can work with that, then you don't lock it in. You wait to see if you can get a lower rate down the line. I can tell you on real estate side, we've seen the demand back off here because, gosh, once it went to 8, 9, 10% mortgages, it just stopped, Right. And I would say that it hasn't caused any serious problem in the real estate business. but you can see things are cooling off, and I think the real estate prices should cool off into 2025. And but I think what will happen is you start bringing those some of these real estate prices down, but you also bring the rates down. You don't have to bring the real estate prices down a huge amount. Suddenly, right. People will see that balance, saying, "Well, now I'm going to lock in that rate. Now I'm going to buy that home, whatever." Mm-hmm. So we'll still see decent demand. The setback in real estate is not the 2008, 2009. That's where we ran the problem where they exploded prices extremely high, but we also ran the rates up. Then we ran into the debt crisis side where you couldn't get financing, things weren't liquid, and then the real estate price just crashed so that people were caught with a home that was worth half what they paid for it. The bankers wanted more money. We're nowhere near that kind of scenario. We cleaned and fixed that system, that type of system up. Okay. So, we're just looking for some modest setbacks here, and the same thing for interest rates. I mean, my work on the 10-year treasury note, hey, we've been, close to 5% there, and I can see it coming back to 3% in the next 2 years. So, if you're up there at that 7 or 8%, geez, suddenly 5 sounds a heck of a lot better than 8. So, yeah. So I think there's an opportunity here for short-term people to do that. If they were long-term trying to lock in for 30 years, I don't know. Yeah. Who knows what goes on by 10 or 20 years. Yeah. But yeah, for short-term, I get it. I think it's okay to do that. And like I say, I've even put my money in that direction, because if you buy bonds, which is what I did, what you're saying is rates are going lower, and that bond's going to be worth more money. So what I'm really doing is trying to lock in those 6-7% rates with the idea I might get out at 5 or 4. And it converts to a capital gain because it's, I might be in for like the 10-year treasury note, but it's very liquid. I can get out in 2 years. I don't have to stay with it for 10 years,
Sure.
So yeah, I think there is an opportunity to take a chance here on this lower interest rate. I think it makes some sense.
Right on. Okay. Well, Rich, that's good stuff, man. If any closing thoughts on this stuff as we head into this Thanksgiving holiday?
No, Thanksgiving I think it's going to be kind of quiet here, maybe in the stock market, and maybe a little selling right after Thanksgiving. That's kind of seasonal. You even get holiday traders. But I got a feeling the stock market will be higher in December. I think we'll probably see a return of discussion of Santa Claus rally. I think we're going to see Wall Street and bankers saying this might be a better ending to the year than what they thought 6 months and 12 months ago. Right. The attitude has changed.
Yep, it had. You abruptly.
Yeah, overnight. I mean, there's some professionals there, well-experienced professionals, that they now believe it, but even they're behind. They didn't think it would turn at that speed. Yeah. So
light speed, no doubt about that, for sure. All right, Rich, appreciate you being on the podcast. One more time with where they can find your podcast, Critical Point.
Go to criticalpointpod.com, or if you just want the list of the audio videos and click on them, you can go to criticalpoint.podbean.com. And again, bean is like soybean. And they can also, on Twitter or X, they can ping me, ding me, whatever it's called, at Rich_Posson, Posson. And they can email me at rich@ag-financial.com.
Yeah, it used to be you tweet at somebody, and I don't know if you X somebody. I don't know what you're doing now.
Yeah, I can't quite get onto that. So I still call it Twitter.
Right on. Well, Rich, appreciate you being on the podcast. When I have a chance to talk to you between now and then, happy Thanksgiving, and we'll talk to you again in December.
All right. Thank you, and you have a good Thanksgiving.
Right on, man. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. Go to LinkedIn at Moving Iron Podcast. I got Snapchat now. You can go to Moving Iron Podcast on that, and I've got TikTok, got that now, so you can check me out there at Moving Iron Podcast. You can see the video version of this over on the YouTube channel, which is the Moving Iron Podcast YouTube channel. And you can go to movingironllc.com for everything Moving Iron related. Got some big announcements coming out here over the next couple of months, and we will have a good time when those come out. We got the Moving Iron Summit coming up here in Nashville, Tennessee. It's weird to talk about a year away, but it'll be here before you know it. November 11th through the 6th. No, that's not right. November 4th through the 6th. Check that out there. Rich is going to be there. He's going to be giving some talks on what he sees happening in the economy. So looking forward to that. So with that, I'm Casey Seymour with Rich Posson. Let's give me some iron, folks. Out.
Moving in the 21st century.